Hi, JJ here with the Art of Value. Today I've got a new interview with Mohnish Pabrai, very recent. It's a session with the Nazi Monji Institute of Management Studies in Mumbai. Not too long ago it was posted up. You're going to want to stick around. I've got some summaries and some main points here which I think are pretty good about Multibagger. Multibaggers finding multibagger companies and his approach to that. So he starts off in the interview with investing in potential multi-bagger investments using a value investing approach, of which he says there are many. I've just broken down some of the main things that I'm interested in. Hopefully you are interested in them too. So you're going to want to hear these, I think. So he says the great thing about investing, unlike things like sport, you can keep getting better at investing throughout your life. It's a continuous learning experience. The first clip that I've got today, he says that large value investing is a large tent. It encapsulates a range of approaches and focuses many different approaches to it, like buying 50-cent dollars or net investing, which is Benjamin Graham, the sort of grandfather of value investing, focusing on spin-offs like Joel Greenblatt, and focusing on cannibals, meaning companies that buy back a lot of their own shares, focusing on multi-baggers, special situations. Another Joel Greenblatt again wrote about that, and merger arbitrage. So all of these can be value investing principles or part of value investing, but he's focusing on multi-baggers. Let's just see what he has to say in this first clip.
When we look at this large tent called value investing, it encapsulates quite a range of approaches and focuses one could have while trying to create wealth and generate good returns and so on. So, for example, buying a dollar that is trading for 50 cents would be a great way to be a value investor. Focusing on spin offs, which Joel Greenblatt wrote about, is another way. Focusing on cannibals, which is companies that are buying back their stock. Looking at what I call spawners, which is businesses that are really good at creating new businesses and then spinning those off. So that's another way one can go. Focusing on multi-baggers is also well within the tent of value investing. One could do special situation investing, merger arbitrage. It's a long list of endeavors and initiatives. Ben Graham suggested net investing and so on. So there's many different approaches one can take, which would all be within the tent of value investing.
It's interesting what he said there. He mentioned spawners, which I didn't mention beforehand. I made another podcast on Pabrai talking about spawners, his spawners framework, if you're interested in that. I was pretty thorough, I think, there, so it's well worth going through. It's really interesting finding his spawners. That's companies that will spawn other companies, create other companies, and become multi-bangers. Okay, so the next one, he talks about his best approach. He thinks the best approach to investing is finding multi-baggers. So that's stocks that go 10x in 10 years or even 100x over 20 years. And there are some advantages to this approach, and he mentions them. Let's see what he says to say.
I've come to the conclusion, and it's actually a pretty, it took me a long time to figure this out, but I think for most of you it would seem obvious, is if there is such a thing as a best approach out of all of these approaches, the best approach, I think, would be one where one focuses on multi-baggers, businesses that can be a 10x in 10 years or less, or maybe 100x in 20 years or less. If one focused purely on the multi-baggers, there are some advantages that come up with that approach. One advantage is that one doesn't have much in terms of taxes because you'll be holding businesses for a long time. Under most jurisdictions around the world, until the positions are sold, unrealized gains are not taxed. So basically, it gives you an advantage. And depending on the place on the planet that you practice this, sometimes the tax rates can be as high as, 40, 50%. Deferring that for decades or let's say 10 years or more is a huge advantage because you get a free interest-free loan from the government. So there's an advantage in terms of taxes with this approach.
Okay, so basically talking about the tax advantage of holding a company for a long time, which you don't pay tax when you pay tax when you sell in most places. And that's a huge advantage rather than trading in and out or selling and then having to buy something more and then paying tax on it. So it's kind of the long run. And Warren Buffett's talked about that as well. All right, so next he talks about with multi-baggers, you don't care if the position becomes fully valued or even overvalued. You only sell if it's egregiously overvalued. So he's talking about holding it for a very long time here to capture all of the value.
But in the multi-bagger framework, what you would do is you would actually not particularly care if a position became fully valued or even overvalued. So for example, if you bought, a business for 30, 40 cents on the dollar and it's growing, that dollar is growing. And at some point it's worth $1.50, for example. It's gone up more than 50% over what it used to be worth. But the stock is trading at $2, for example. So under traditional Gramian approaches, you would sell that as you get past the $1.50 or whatever. But in the quest for multi-baggers, you would continue to keep it in your portfolio even when it became overvalued. You would sell it if it became egregiously overvalued. So one would need to distinguish between something that's overvalued and something that's egregiously overvalued.
Okay, so only selling if it's egregiously overvalued. Warren Buffett's mentioned actually. I mean, he and Munger, Charlie Munger, tend to do this. They hold on even if it gets into a bubble situation. Like Coca-Cola in the 1990s, they held in various stocks that have been overvalued, or you could say they're overvalued. Possibly they didn't sell, just held. So he's talking about that too. All right. So the next concept he talks about Chuck Akra's three-legged stool. So he's another great investor. And he talks about the 3 points here, the three-legged stool, about the core economics of the business being great, high integrity management, good insider ownership, alignment of interests to shareholders, and a very long way. The company has a very long runway for growth. Let's see what he has to say. In terms of core economics, it's interesting what he says there, what's a must-have, and value investors will be familiar with what he says here.
The three legs that we need, I think Chuck Akre calls it the three-legged stool. The three legs that we need for these long multi-baggers is, first of all, the core economics of the business should have very high returns on invested capital, ideally without the use of debt, right? So you basically, like McDonald's doesn't need to borrow money to make a lot of money. The second is that we want very high integrity management. And we want insider ownership, kind of alignment of interest, where there's a smart entrepreneur or someone or insiders who own it. So they've got incentives. And the third is that we want a very long runway. So where we can see that this thing can go on for a very long time.
Okay, just to reinforce that, he said, it's because it's important. I think this is one of the most important concepts here, and it's not from Pabrai really, but he's taken it on from Chuck Akre. Might talk about him in another podcast at some stage. He talks, the high return, very high returns on investing capital. A lot of investors look for that, especially return on capital employed if you're a value investor, and high integrity management. Well, high insider ownership, really important. Then management's aligned with shareholders, and of course strong runway for growth, which growth investors look for too. Okay, so next we have, if the runways are really long, several decades, in fact, even an expensive looking price in the beginning when you buy it can be a great value investment. And Charlie Munger's talked about this. He has reportedly, convinced Warren Buffett of this, that it's, if it's a great business, pay up a little bit, not too much, as we've seen in recent, like from 2020 on. That can, you can come to grief by paying up too much. But he said we have but we have to be, as value investors, he mentions this, you have to be skeptical still. We can't assume everything is going to the moon, and there will be a lot of competition for the moats. If a company has a moat, there'll be other companies that come in and try and take some of those profits. Say operating margin, for instance, to grab that. There's that going on in the cloud space, cloud storage space. It's a good business, so companies will come along and try and take some of that market share. So they've got to defend their moat. Okay, let's see what Pabrai has to say about this.
If the runways are really long and they actually end up being runways that go on for several decades, then even an expensive looking price can end up being a great value investment. But I think that as value investors, we have to also have a good dose of skepticism in how we approach these things. So we can't always assume that everything's going to go to the moon in terms of size and growth. And the nature of capitalism is that there will be a lot of competition that will try to go up against those moats.
All right, that's it. Okay, I think I'm going to leave it there because we're coming to the 10-minute mark. There's more. There's probably a second half there. I'm going to do another episode on this because I think what he's saying here in this interview is really important, really great for just the basics of. He makes it seem simple, even though it's not simple. Well, it's kind of simple but not easy, as Charlie Munger said. Investing is simple but not easy. I think it was Charlie Munger who said that. All right, so we'll leave it there. If you found value in this, please like and subscribe on YouTube and follow elsewhere on Spotify or other podcast apps, and join me at The Art of Value. And thank you for listening. I appreciate it.